So in the first video, we looked at what private credit is and why it grew so fast. The story up to this point is a reasonable one. There's a market gap, a regulatory shift, and genuine economic contribution. Hi, my name is Paul Carroll, the CEO and founder of Avion Wealth. And this video is about what's happening right now in early 2026, because several things have changed. And if you're an investor being pitched private credit products today, these developments deserve your full attention. In the first quarter of 2026, three things happened in quick succession that you need to know about. First, Cliffwater's flagship private credit vehicle, one of the largest retail accessible funds in the space, with about $33 billion in assets, they limited investor redemptions to just 7% of shares after investors tried to withdraw nearly twice that amount. Second, Morgan Stanley's North Haven fund, with close to $8 billion in assets, honored only 45% of the redemption requests after investors sought to pull out about 11% of the net asset value. And three, JPMorgan marked down the value of loans that it holds as collateral against private credit funds, specifically flagging concerns about software company borrowers being disrupted by artificial intelligence, and indicating that this would tighten lending to those going forward. Each of these elements on its own would be completely explainable, but they're beginning to represent a pattern worth examining carefully. You see, default rates among private credit borrowers have been rising from historically low levels. In fact, Deutsche Bank projects defaults could reach between 4.8 and 5.5% before the end of the year. And UBS has projected an increase of as much as 3 percentage points, potentially outpacing default trends in leveraged loans and high-yield debt. Morningstar has issued a negative outlook for the sector, citing weakening profit margins among borrowers. Look, these numbers matter to you, but understanding them requires one more layer of context. Private credit lenders have two tools that allow them to defer or obscure credit deterioration. The first of these tools is called payment in kind interest. Instead of paying cash interest, a borrower is allowed to accrue additional debt. The lender records the income on paper without receiving the cash, and the borrower's debt load grows. The problem is deferred, not resolved. If anything, it's getting bigger. The second that you need to know is called liability management exercise. And that is when a struggling company renegotiates the terms of its debt. It could be extending maturities, adjusting covenants, swapping instruments, without formally triggering a default. Now, from the outside, the loan portfolio appears to be performing, but in practice, this company and others are in distress. When these mechanisms are factored in, the effective distress rate of private credit portfolios is materially higher than the headline figures suggest. Some analysts estimate that the true distress rate is approaching or exceeding 5%. That's about double what traditional metrics are reporting as recently as 2023. So one aspect of private credit that rarely appears in marketing materials is its indirect connection to government-backed funding. Now that's a surprise, isn't it? The Federal Home Loan Bank system carries an implied government guarantee, which allows it to borrow at near Treasury rates. Now the Congressional Budget Office estimates this implied subsidy is worth about $6.9 billion a year. Now, while private credit firms are not direct members of the Federal Home Loan Bank system, they have accessed this subsidized liquidity indirectly through member banks that lend to the private credit vehicles and through insurance company affiliates. They're getting backdoor financing from the government. Bank lending to private credit vehicles increased by about 145% between 2020 and 2024, reaching around $95 billion. Now, this kind of interconnectedness between the private credit and the regulated financial system, it's the kind of linkage that makes contagion possible if stress is spreading. Regulators have expressed concern about the opacity of this space. And unlike banks, private credit funds are not subject to the same disclosure requirements. So that means regulators and investors lack full visibility into the exposures building across the system. Now I want to be straight. This is not a forecast that private credit will collapse. The asset class at roughly $2 trillion remains smaller than the traditional banking sector, and it's not designated as systemically important, though it may be more important than we realize. The more likely near-time scenario is not a crisis, but a slow erosion. Continued redemption pressure, the tightening of bank credit lines to private funds, and a gradual repricing of risk. But for retail investors being presented with these products today, the question is not whether the asset class survives. The question is whether the current risk-reward proposition justifies a new allocation at this point in the cycle. And this is what we're going to address in the third and final video. Is the juice worth the squeeze? If your current portfolio includes private credit, or if you're being presented with an opportunity to add it, these developments are worth noting and reviewing with a qualified advisor before taking action. At Avion Wealth, we offer a complimentary second opinion review for investors evaluating their alternative allocation strategy.